Hi, Larry Gaines, PowerCycleTrading.com. In this video, I want to show you an option trade that sells volatility. So when we get into earnings and earnings trade or an earnings season, as you go into the date of the earnings announcement, volatility, implied volatility increases. So one trade that you can do to take advantage of that is to sell volatility by using what we call an iron butterfly. So I'm going to walk you through an iron butterfly strategy for selling volatility in time. So in this example, this is Procter & Gamble, and it's got its earnings were going to be released on the 20th of October. Okay, so we want to look first. What I do is I look back at past earnings expected move history. So typically it moves around 3% up or down. And then I want to look to see, well, then what did it do at expiration? So here 3 days would be expiration for Procter & Gamble. So you can see over the last earnings cycle in July, it closed up 2.19%. The cycle before that, 2.63, down 0.93, 4.8, 0.63, 2.58, and 3.49. So if you just notice that, you can see that the moves aren't very big. They tend to kind of be around or within the expected range of the expected move. So the next thing you do is then look at constructing an iron butterfly. And what we're going to do for that is we're going to sell. Basically, you go short a straddle and long a strangle. So kind of walking through the trade. So here's Procter & Gamble. The earnings we're going to be on the 20th before the market opens, so you have to set the trade up the day before on the 19th. At that point in time, it's trading 141.91, and then the expiration is for Friday the 23rd. Now, if you look at the expected move, we look at the implied volatility where my pointer is. It was going into the earnings release 33.38%, so it was saying that the move would be expected move of $4.29 up or down. So that's the range that the market was expecting, and that was based on where it was trading at the close on the 19th. So what we're looking at is, higher implied volatility in the front week series, so the 23 October, 4 days to expiration. Now what we're going to do is we're going to sell that volatility, and we're looking for that to go down, which it does. It tends to collapse after an earnings release. So here it is the next day. So once earnings were released on the 20th, you can see that the volatility collapsed from 33.38% on the 19th, collapsed down to the 20th on 24.23. right here, so down 9 points. So we're selling that volatility. So let's take a look at the chart, and then I'll show you the trade. So here it is on the 19th, right there. So it was closing price was right here, 141.91, and then the expected move up was around 3% up, so that would put it up the expected range to the upside 146.20, and to the downside 137.60. So we're looking to set this trade up in iron butterfly where we're selling volatility, and we don't want a lot of price movement. We just want to take advantage of volatility collapsing. So you can see this blue line here is the implied volatility. See how it expands up as it's approaching earnings, and then it starts to fall down after. So you can see it here, the last earnings cycle back here in July collapses there. So that's what we're going to take advantage of. So here's how the trade sets up to sell volatility. So again, on the 19th, the day before the release, the setup was to sell the at-the-money call, the 142 call here, and then buy, what we do usually, you typically buy the wing above it based on the expected move. So this would be $4 up or $3 or 3% higher. So selling short the 142 call, buying the 146 call above it. So if you look at that, that would be an at-the-money bear call credit spread based on that close on the 19th. And then you do the same thing. You sell the 142 put short, and then below that buy your coverage, to cover that spread at 138. So $4 below. Okay, so 3% below, 3% up. So now you're short a 142, 146, and then a 142, 143, 138 iron condor credit spread. So here's the other way to look at it. So basically the spread then is the iron condor butterfly. So you can see you're short the 23 October, that expires tomorrow, Friday, the 142 call. You're long the 146 above it, then you're short the 142 put, long the 138 below it. So a straddle surrounded by a strangle. Now, the total credit received is your maximum potential profit, so $289, and the risk is the difference between the spread width, so your risk is 111. So if this was to expire perfectly tomorrow, Friday the 23rd, right at that short strike of 142, the trade would make you'd keep the full credit of $289. And on your risk of a 111, that's a 260% return. Now you can see that today it's going out pretty close to that right now, today the 22nd. So it's up $163 from those spreads starting to collapse. And so that's up about 145%. And then tomorrow, flip my date over here, you can see that if we're trading right here tomorrow, right on the open here, this will be up about 194, about 174% return. So what you're doing is you're playing for volatility collapse, and this is one way to do it using what we call the iron condor butterfly. So we're selling volatility and we're selling time. So I hope this helps. And if you'd like to learn more about these types of strategies, make sure to check me out at PowerCycleTrading.com. Thank you for watching this video.